Welcome to the Spheria webinar on Australian small and micro-cap reporting season analysis. Today the Spheria team are going to outline some of the wild dispersions we've seen in returns, take you through some stock stories and provide you with an outlook. My name's Mark Cormack and I'm a director with Pinnacle Investments. Pinnacle are equity partners and work alongside Spheria to distribute Spheria's investments to the Australian financial advisory marketplace. And today I'm delighted to have both the founders and lead portfolio managers of Spheria, Marcus Burns and Matt Booker, to take you through today's presentation. In brief, Spheria are an independent fund management boutique who specialise in Australian small, micro and mid-cap investing. Since establishing the Spheria Microcap Fund, the team have delivered a 10% return. The Small Cap Fund has delivered an 11% per annum return, and both these funds have outperformed both the Small Ordinaries and the Emerging Companies Index. In addition, many investors are probably not aware, but Spheria also manage the Spheria Opportunities Fund, which is a mid-cap Australian equity fund that has also delivered 11% per annum returns since its inception in 2016. In addition to the managed funds, Spheria also manages the Spheria Emerging Companies Listed Investment Company, which is another way investors can access Spheria's investment capabilities via a direct equity LIC, and that code on that LIC is SEC. Before we kick off, just a couple of quick housekeeping items. Today's Spheria presentation will last around 15 minutes and that'll be followed by a Q&A session where all attendees have the opportunity to ask questions via the chat box at the bottom of your screen. So without further ado, I'll hand you over to Spheria's portfolio managers, Marcus Burns and Matt Booker, for today's presentation. Thanks, guys.
Thanks, Mark. It's Matt speaking first. Just on slide 2, and this is a busy slide, so I'll try and break it down and simplify it. The top table is the Smaller Companies Fund, which I'm sure you're familiar with. Clearly, it's had a good run since inception, so it's delivered 11% per annum since it was incepted in July 2016. And what you've seen more recently is strong performance. So we saw the back quarter of 2018 was actually a difficult quarter for the market. You saw a big retracement in the share markets globally, and the Small Ordinaries obviously took a hammering during that period. What we've seen since then is a huge bounce out, so a huge rally out of those lows, and you've seen the Small Cap Fund has managed to keep up with that pretty furious rally in that space. And last month, the Small Cap Fund did 7% return versus the Small Ordinaries, which did 6.8%. So you can see it actually outperformed, which is a good result. We had a lot of good profit results last month in the small cap market, particularly in stocks that we own. So that was a good result for us. If you move to the table, the second table or the middle table, you can see the Microcap Fund. It has lagged the Small Cap Fund over the last year or two. And the reason for that, in our view, is just that microcap space is lacking interest. It was very popular a couple of years ago and you saw a lot of money plough into the microcap space, and I think you've seen that money now move out of that space. And with that has actually come a lot of opportunity, and Marcus will talk to this in the next slide. But you've seen, just a lack of interest in that microcap space. What we have seen recently, though, is that microcap fund has bounced back, and although it has lagged the index, it's done reasonably well considering just the lack of interest in that microcap space. The third table, and Mark mentioned, is our Opportunities Fund, and that's an X50 fund. So this one goes up the market cap spectrum. The Small Companies Fund is obviously X100. This one moves up into that 51 to 100 names. And so they're bigger companies that we're looking at, but companies that we have invested in before and that we've covered before. So it's a very familiar territory for us. We've been running this product since July 2016, and you can see the performance has been very strong versus the index. We're finding good opportunities in that mid-cap space, but it also does invest down into small caps and to some extent into microcaps. So there's a good overlap there in that fund, and that's why it's called the Opportunities Fund, because it can move up and down the spectrum and take advantage of valuation opportunities that appear at either end of the spectrum. So that fund's performing pretty well. I'll move on to the next slide and let Marcus talk about the microcap space for a moment.
Thanks, Matt. It's Marcus Burns here. Just quickly on slide 3, we're just highlighting here the fact that microcaps have particularly lagged the small cap space, and It's interesting, if you go back over a longer period of time, that lag is fairly unusual, and there's usually a catch-up period where microcaps have a bit of a run to catch up with the performance of the small companies. The small companies have been driven up by a lot of money flowing into the more sort of momentum-y, techie type names. We've participated in some of those, Technology One being a stock we've held for a long period in the fund, which has been an exceptional business and has performed very well for the funds. So we don't eschew owning tech stocks. We just make sure we pick and choose the ones that we feel meet the criteria we're looking for. But just to highlight that page again, we think there is a good opportunity now in microcaps. One of the big themes we've seen in the larger end has been not just the momentum of the top end, but also a fair bit of corporate activity has occurred in that small cap space. And our funds have been a beneficiary of a number of those takeovers, including Navitas and others, TradeMe last year. And we feel that there's a reasonable chance that you might see corporates and venture capital and private equity funds drift down the cap spectrum in order to take advantage of some of that valuation anomaly that's particularly prevalent in the microcap space.
Moving on to slide 4, and this is a slide just on the movements in reporting season. So it's the top 20 and the bottom 20 performers in the Small Ordinaries Index in that February period. So it really captures some of the volatility during that period during reporting season. And you can see it was a wild ride. You had stocks moving up 50% plus, and you had stocks falling 30% during that period. And often the case was that they were moving wildly just on the reporting, on the actual date that the company reported. So any sort of change in earnings, either positive or negative, was quickly imputed into the share price and imputed in a significant way. So if you look at the top end of that chart, you can see that the biggest mover in that February period was BWX, which is a skincare company. It owns Sukin. You're probably familiar with that brand. And, a couple of years ago, it was a market darling. It IPO'd, had magnificent returns, and then it lost its way. And what you've seen with that company is the stock has retraced from, I think, $7 or $8 down to, I think it got down to the high ones recently. But there was a furious short covering rally during reporting season in that name. So there was a lot of hedge funds that shorted the company. The result was actually poor, but the short covering saw a significant rally in that share price, so nearly 50%. We don't own that company. We haven't owned it for some time. We made quite a bit of money out of it. It was one of our stocks in the portfolio a few years ago. And it's not one that we're considering at the moment. We think it's overvalued, and there's a lot of challenges ahead for that business. But what we did own, you can see highlighted in blue, we owned Breville Group, which was up over 40%. So we took a position in Breville Group last year around $11. You're probably quite familiar with it. It makes toasters, juices, mixers, blenders, all sorts of things. It's got a fantastic brand. Most of the business is actually offshore, so most of the business is in the US and increasingly in Europe. Australia is becoming a much smaller part for the Breville Group. But we took a position at $11. That's rallied nearly 50-60% since the result. It was a fantastic result. I think the market expected some risk with that business because the consumer has been weak, particularly domestically, but the company's ridden through that. It's taking market share globally. The management team's done a fantastic job there, so we're very happy with that company. The other rebounds we saw were Platinum Asset Management and Infomedia. Platinum's rebounded from a very oversold position. We think it's quite attractive down here. The stock is cheap when you adjust for the balance sheet, the cash in the balance sheet. Infomedia's had a huge bounce back. We bought that company a few years ago when it was in the 50s. It's now bounced up to $1.70. We've actually exited the position into that strength. We think it's expensive. Management's done a fantastic job with the business. It is a great business, but we think the multiple is just way too high for that company at the moment. So it has found popularity again after going through an unpopular period, and obviously we've made quite a bit of money out of that one. The one disappointment for us was Blackmores. So Blackmores came out with a profit result which was very disappointing. Again, they showed fantastic top-line growth. They're getting real traction into the Asian markets. China has been an issue for them. And, those China challenges, they are surmountable, but at the moment they're finding it a very difficult market to get the strategy right. But we think they will get the strategy right over time. It's a fantastic brand. The biggest issue Blackmores has had is just costs. It's a very inefficient business, and we'll talk about that later on. But we think there's upside in that business, and we think at these prices, there's quite a good story there. So a very wild reporting period. I think we found a few good ideas during that period, and we've also had situations where we've made quite a bit of money. And Marcus will now talk about City Chic, which is one of our good performers.
Yeah. Right, so just going to page 5, it's always good to give some stock examples to kind of bring to life, how we think and how the team operates when it comes to picking and investing stocks on your behalf. City Chic Collective, or CCX, is a retailer that sells larger size fashion for women. The reason we like this stock, and it also highlights how the team operates, is that it was part of Specialty Fashion Group, SFH, which had been a laggard on the stock market for a long period of time. They had, amongst their long coterie of brands, they had 6 different brands in that portfolio, one of which was City Chic, which had been outperforming, but they had a tail of 5 other brands that were, frankly, sort of moribund and struggling to get earnings. And so, Specialty Fashion Group sold off that tail of brands to Noni B. There were 5 brands in total that were basically collectively losing money and had a lot of lease liabilities. In that transaction, they received cash, so the balance sheet for the remaining company received a lot of cash flow and effectively got rid of a lot of liabilities in the form of leases. So we had a good look at that transaction on the day that it occurred and saw in the rubble of SFH a very, very attractive operating business called City Chic. Now, the other thing we like about City Chic is it's about 40% of the revenue comes online. And secondly, it's already has close to 20% of its revenue coming out of the United States. So it's already proven that it can sell fashion internationally, which is often a stumbling block for Australian retailers. And it's also proven that it can sell successfully online. Again, something that many retailers are trying to emulate, but at 40% of the revenue online is a very, very large skew. So successfully established business, still, despite the fact the shares have performed very strongly and actually made the funds a lot of money, particularly microcap funds, we think there's good upside as they continue to roll their stores out, both here and potentially internationally in the medium term. Stock trades on about 10 times EBIT. That's a valuation multiple we typically look here because it strips out debt or cash on the balance sheet. So we think it's still an attractive multiple, and we think the stock should report earnings growth in the mid to high teens for at least a couple of years out and pay good dividends. So that's an example of a sort of turnaround in the business that, if you like, a change in the structure of business that we found attractive. And upon closer examination, we discovered an attractive opportunity in that share price move.
Excellent.
Now I'll hand over back over to Matt to talk about Blackmores and why we still like that stock.
Yeah, thanks, Marcus. City Chic, fantastic story. Blackmores, I spoke about before. Execution has been the issue at Blackmores. I think if they had the management of City Chic in at Blackmores, the Blackmores share price would be a lot higher. Probably have a 3 in front of it, actually. But so what's happened here? You can see in the chart on the left there, and this is the chart that we always put in for our companies. The dark blue is the free cash flow for the business. So that's all the cash flow that goes back to shareholders effectively, versus the light blue, which is the earnings. So you can see that historically they've been a pretty good cash flow generator. Obviously, with the growth in sales, there's a build-up in working capital, and so that does detract from the cash flow conversion. But over time, a good cash flow business, obviously you can see that the earnings have grown a lot over time as well. So if you go back to 2014, the company was generating around $40 million of EBIT, around $40 million of cash flow as well. In 2018, it's generating cash flow of about 80 and earnings of about 100. So you can see that the earnings growth has been good. But if we put another chart in just showing the sales growth has been absolutely stellar for this business. So in 2014, the company had $350 million of sales. Now, organically, it's grown to around $750 million in sales in 4 years. So it's nearly doubled its sales of the business. But if you look at the chart on the right, the actual margins have gone pretty much flat. They went up briefly. They peaked at 20%. So that's where they got the benefits of scale. They kept their costs in line and they got margins up to 20%. But they've debased down to 14%, which we think is very poor. We look at the competitors, and Swiss, which is obviously the other big brand, supplement brand in the market, is doing over 30% EBIT margins. Blackmores is doing 14%. It's just not good enough. And what you saw recently is the CEO has resigned, and they're looking to bring in someone new. And that new person will drive, we think, an efficiency strategy where they'll take out significant cost in the business. Now, if this group can get margins up to 20%, we think the business will be worth $160 because basically that incremental margin goes straight through to valuation. If they can get up to 30% margins, I mean, this business could be worth $250. So it is really an execution issue. We think the risk is skewed to the upside for the business. We think that the new management team or the new CEO will have a mandate for change. Marcus Blackmores has communicated that in the press. That's what they want to see, some change, and they want to see greater cost efficiencies out of this business. So we think things are skewed to the upside. We still think there's tremendous growth into Asia, not just in China, but ex-Asia. They've got a fantastic market share in Thailand, Malaysia, and Indonesia, and there's a great platform to grow into those markets. But also, that Chinese market, if they can get it right, that could be huge for this company. So we're still favourably disposed to this company.
I think I'll just add to Matt's comments there. This is the kind of opportunity that I think the fund and Spheria picks on really well. So it's a good business with, as Matt touched on, good cash flow. Balance sheet is almost ungeared, and the valuation is now appealing because the stock price has pulled back pretty aggressively over that first half set of results. They were disappointing results, frankly, but I think our view as a company is recognise that the management team has been changed, and better execution should start seeing some operating leverage come through in this company, which if it does, as Matt said, probably see a re-rating in the shares. Notwithstanding that fact, that, as Matt said, the risk-reward skew is favoured to the upside, and there's kind of low risk upside kind of skewed risk-reward return that we really pick on when we're investing your capital for you. Just to finish on an outlook on page 7, you can see that we've just re-highlighted there. We think, frankly, valuations in the smaller end, microcaps in particular, are very attractive relative to the larger end of the small cap space. It's lagged the growth in the top end, and multiples are definitely materially cheaper. Both funds, but particularly the small cap fund, has been a beneficiary of a lot of M&A activity. As we said to you probably last time, we think that's likely to continue for a period of time. It probably skew a little bit smaller in terms of market cap size, given that's where the relative value has appeared. Balance sheet's still cashed up pretty well for acquirers, and private equity is still very actively looking for ways to deploy capital. And all the hallmarks of the things we're looking for: cash flow generative businesses, valuations, and low geared balance sheets are exactly in the crosshairs of what private equity and venture capital and acquiring corporates are looking at when they're looking to make deals happen. And in the medium term, we are starting to see some of the cyclical stocks offer value. So, without pointing too closely, obviously the car retail has been hit with the downturn in consumer Australia. Retailers have been under pressure, and so too have media companies and anything related to the building cycle. So there's some of the areas that we're turning over and starting to see some value appear in. And on a longer term basis, we think some of those names are looking attractive to maybe add some incremental, investment funds to. So that's our kind of view on the stock market overall. And I'll just leave you on page 8 with our current positions in each of the 3 funds, the top 10 holdings.
Fantastic, guys, and always great to get your insights on the opportunities within the small and micro cap market. There have been a couple of questions come in, so we'll start with those. Guys, what's your view on Mortgage Choice following the Royal Commission findings?
Yeah, look, we've increased our position in Mortgage Choice. We thought the Royal Commission, we were actually flabbergasted by the outcome of the Royal Commission in terms of banning commissions. I think they focused on one part of the value chain, and they missed out on the bigger picture, which is obviously the banks and how much money they're making. But look, our view on Mortgage Choice hasn't changed. We think in a run-off situation it's worth $1, so you're buying it on a worst case basis now. It looks like we won't get the worst case basis. Obviously the existing government's backflipped, and they're not looking at eliminating trail commissions. They're going to leave in place trail commissions for at least the next 3 years. And there'll be some reviews done over that period. So they've seen the importance of the broking channel. 60% of the market is now through mortgage brokers, and there's a reason for that. That's because they get you a good deal. I can vouch for that. Many years ago, I went direct to the bank. They pretty much legged me over. I went to a mortgage broker a few years later, and I got a significant discount. And that's what the consumer wants, discount. They want a competitive market, and without brokers, you're going to lose competition. The big banks will win in that equation. And I think the sensible, Liberal Party's come around to the senses. I think the Labor Party is obviously reviewing its stance, and they might also backflip as well on their view. But even the Labor Party's view of moving to a 1.1% fee paid by the bank is quite positive still. So we actually think the risks are highly skewed to the upside. We actually think lending is starting to turn around, so the banks really tightened credit standards last year. We're hearing there's been a significant loosening of credit standards, not to where they were prior, but they've definitely relaxed. And now those approvals that were getting declined last year are now getting approved. So you're starting to see a turnaround in the lending market as well. So all the things that went wrong for Mortgage Choice are now looking quite positive going forward.
Excellent, guys. Another question. Outside of City Chic, do you see any hope for retailers in the Australian, with the Australian economy potentially slowing?
Thanks. Any hope for the retailers? That's a bit of an exaggerated comment. Look, I think we do. And I mean, one of the things I flagged in that outlook was retail stocks have been sold off very aggressively in many cases. A lot of them have traded pretty well through that period already. Things like Adairs, for example, had a really good set of results and haven't seen much of an impact from the consumer. Others have seen a tougher time. I think share prices often overreact during tougher trading periods, and in many cases those share prices have fallen back to levels that we think are starting to offer long-term attractive value. So yeah, definitely offer opportunity. Obviously, you've got a confluence of negative events for retailers, tough consumer, Amazon arriving here, rents have been tough. So that hasn't been a great outlook for retail, and that's been reflected in the share prices. So yeah, I think there's good opportunity appearing broadly in that sector.
While we're talking retailers, is a question on Vita Group. Do you see that as a retail play or a play on the 5G rollout in Australia?
Look, it's a good question. Vita Group, just to remind you, is a franchisor of the Telstra name, so it runs a T-Life stores, roughly 105 of the stores on behalf of Telstra. Telstra has about 300 retail outlets in total, and 105 run by Vita Group. So they are a play, I guess, on 5G to some extent, but just more that cycle on mobile phones. So people, when they upgrade phones or sign a new plan, go through a Vita store and pay commission. They also earn a lot of money selling accessories, where they make a good chunk of their profit as well. And they've expanded more recently into non-invasive medical surgery, so minor cosmetic surgery. So I think we think the business is very, very cheap on a long-term basis, trading at about 5 to 6 times EBIT. No gearing in the balance sheet, pays a good dividend, and with that TPG Vodafone merger likely to be approved. I mean, it hasn't been approved yet, but with the fact that TPG has pulled out of rolling out a fourth mobile network, that should prove very favourable for operators like Telstra and in turn Vita Group.
Guys, do you have a preferred sector that you're most keen on in the small microcap space at the moment?
Not especially. We tend to we try to be agnostic to sectors and look at cash flow and fundamentals. So as I flagged, I think we're finding value in the cyclical side of things. So we're spending more of our time looking at some of the names and sectors that have been beaten up a little bit. But we're not ignoring all sectors. So all sectors on our radar screen, including resources and biotech, etc., as long as they meet the process fundamentals, so their cash flow requirement mark. But yeah, we're probably spending a little bit more time looking at those cyclical sectors. We don't have a favourite sector now, and we certainly try to avoid having favourite sectors going forward, because we think that blindsides you to good opportunities in sectors that might be less popular.
And it's fair to say, with your preferred companies, they're the highest weightings in the portfolios at the moment.
Yeah, we skew to obviously we skew to two things: valuation upside, and with an eye to looking at the risk. And so when risk levels are high, we reduce the weighting in the fund, even if we see upside in terms of valuation. And so what we're looking for is that lower risk, good upside valuation kind of combination. Why do we exist? We really exist to try and deploy your money in a way that's very effectively trying to reduce risk, whilst giving you exposure to upside and share prices, and we don't want to compromise that just for upside and share prices. So we very much take a bifocal view on those things, on those two attributes.
Okay, this could be a left field question. Do you have a view on Botanix Pharma, BOT?
Thanks, Mark. No, I don't have a view on that stock in particular. No, I mean there's a huge tail of stocks that we wouldn't look at, and I don't think that I've had a quick look at them. I don't think it makes cash flow at the moment. I need to double check, but we don't have a strong view on that stock, no.
Okay. You're holding in HTNA. Is it a tactical holding in and around advertising around the election?
No. HTNA is the old APN business, so it's effectively now basically a radio company, radio business. It's not tactical. We hold that stock because it's gone through some fairly major restructuring. It sold off its outdoor business last year. It received a lot of money from that, so the balance sheet got drastically de-geared. We think what they're left with is a fairly resilient radio business. It's the leading radio business in Australia. That goes through cycles like any advertising business. And obviously with the advertising slowing down in the final quarter of last year, those shares come under a bit of pressure. That's really one of the sectors I'm talking about when I say the cyclical sectors have come back and are looking to us to be quite good value. In that subset, I would include HTNA as one of those stocks. So its radio business has been pretty resilient through both boom and bust times. It's been pretty resilient to the internet. It makes great cash flow. And with that balance sheet having been de-geared through selling off the outdoor business, it's also buying shares back. So it's doing everything we'd like them to be doing. Very rational allocation of capital, good cash flow, and a really good valuation. So no, we think it's a long-term holding. It's not tactical around the election spend at all.
Excellent. Okay, guys, in terms of your funds, and it's been a pretty wild ride, what's the beta on your funds, and have you been holding much cash?
Thanks, Mike. Look, we don't. The funds typically, have cash weighting between 3 and 7-8%. So, call it 5-6% long term. That's not a view on the market. That's just opportunistic. So if we sell a position, we'll go back to cash until we, redeploy the money. The beta of the funds, to the extent that that measures risk, typically is anywhere from 0.4, 0.5 for the microcap fund to about 0.7, 0.8 for the small cap fund. So we typically have lower betas than the amount of stock the funds wobble around, if you like, compared to the marketplace. How directly it tracks the movement in the marketplace. So a beta of 1 means you track the marketplace directly. A beta of less than 1 means you move around less than the marketplace. And we tend to have a lower beta and lower volatility than the market, which I think is testament to the fact that we're looking for stocks that have lower risk qualities and cash flow balance sheets and valuations that stack up. And so the outworking of that is a lower risk portfolio, which we tend to have. Okay,
we have got a final question which I will cover now. More around SEC. We've seen the NTA tick up, and it is trading at a bit of a discount. We're very active in the market with respect to communication, so I can cover that question off there. We're certainly aiming to close that discount as much as we can, and the Spheria team are performing well in terms of managing the portfolio. So in terms of that, we're certainly very active in the market, and we see it as a very good opportunity for clients to get into that investment, which is effectively the same as the small cap fund at a discount to NTA.
Yeah, I'd just like to add one thing on that too. We get a bit of, we had people obviously ask the question around the discount to NTA. I think it's a little bit like the same question you'd ask of a manager of a company if they were running a business and the business was running pretty well and the share price was disconnecting from that. What should the management team do? And the only thing they can do is continue to run the business as efficiently as they possibly can. I think Matt and I and the team are very focused on generating the best possible returns we can whilst controlling the risk of the investments for clients. We think that's an attractive offering for clients, and our view is it will be reflected in the share price of the SEC over time. We've made a substantial investment in the fund ourselves, so we think the gap is too big, and we think the assets are attractive. And I think yesterday the chairman of the SEC bought more shares as well. So we think there's value there. Over time, the market tends to be fairly rational, and we believe it will mark the shares back up to fair value through time.
Excellent. Look, that's all we have time for today. We will be making the webinar available on the Spheria investment website, which is www.spheria.com.au. We'd certainly like to thank you for your participation today. If you do have any further questions, please do not hesitate to contact the Pinnacle Distribution team or refer to the Spheria website. Thanks for your time, and we certainly look forward to discussing Spheria with you at our next webinar or in your offices. Have a great day.